In 1998, one hedge fund held a bomb with a $100 billion fuse. 50 banks had lent them money. The Russian government just defaulted, and if this fund failed tomorrow, your retirement account would vanish with it. This isn't a movie. This is long-term capital management. They had 2 Nobel Prize winners. They had a former vice chairman of the Federal Reserve. They had trading algorithms so advanced that banks threw money at them without asking questions. And in one summer, they lost everything. But here's the twist. Their collapse almost took down the entire world economy. Not because they were criminals, but because they were too smart. The year is 1993. A man named John Merriweather has a problem. He just got fired from Salomon Brothers, not for losing money, for not reporting a crime fast enough. So he decides to build his own hedge fund. Not a small one, a massive one. He calls his old trading friends. Then he calls 2 academics. Their names are Myron Scholes and Robert Merton. They invented the formula that changed Wall Street forever, the Black-Scholes model. Think of it as E equals MC squared, but for stock options. In 1997, they will win the Nobel Prize. Merriweather also recruits David Mullins, the second highest-ranking person at the Federal Reserve. So here's the team. Wall Street legends, academic geniuses, a former central banker. Together, they raise $1.25 billion. That's unheard of for a new hedge fund. Wealthy families invest. Foreign governments invest. Even the Italian treasury writes a check. Warren Buffett says no, he doesn't trust the strategy. But everyone else does. Because in the first 4 years, long-term capital management does the impossible. Year 1, up 28%. The stock market was down that year. Year 2, up 59%. Year 3, up 57%. Year 4, up 25%. They turn $1.25 billion into nearly $1.25 billion into nearly $7 billion. Nothing can stop them, except for themselves. Here's how they made money. They found 2 things that should have been the same price, but weren't. Example, a brand new 30-year Treasury bond, and the exact same bond issued 6 months earlier. The older one was slightly cheaper, not because it was riskier, because fewer people were trading it. Long-term capital would buy the cheap one, borrow the expensive one, and wait for the prices to meet. See that profit? Tiny. Maybe 1%. So they did something dangerous. They used leverage. Here's what that means. You have $1 billion of client money. You don't use it to buy bonds. You put it in a savings account earning 5%. Then you call a bank. You say, lend me $25 billion. Now you're trading with 25 times your actual money. If the trade works, you make 30% instead of 1%. If it doesn't, you lose everything, fast. By 1997, long-term capital controlled $1.25 trillion in bets. That's more than the entire GDP of Canada. And the banks loved it. Merrill Lynch lent them billions. The CEO played golf with Merriweather. Salomon Brothers lent them billions. 50 different banks lined up to hand over cash. No one asked hard questions, because the math was perfect. Scholes and Merton calculated that a big loss would happen once every 50 years, maybe once every 100 years. They were wrong. August 17, 1998, Russia defaults on its debt. Most investors thought this was impossible. The debt was in Russia's own currency. They could just print more money. But they didn't. They just stopped paying. Markets panicked. Long-term capital had placed huge bets on Russian bonds. Bad bets. On August 21st alone, they lost $553 million. That's 15% of their entire fund. In one day. By early September, their $5 billion had shrunk to $5 billion, had shrunk to $2.3 billion. But here's the nightmare. They had $125 billion in open trades, leverage of 55 to 1, meaning if their bets dropped just 2% more, every dollar would be gone. They tried to raise money, called Warren Buffett. He said no, called George Soros. He wanted to help, but couldn't find a partner. No one would save them. September 23, 1998. The CEOs of 14 major banks sit in the Federal Reserve's boardroom. The New York Fed president tells them, if long-term capital collapses tomorrow, every bank in this room loses billions. Then you all start selling everything. Stocks, bonds, everything. That fire sale crashes the entire market. He gives them one option: pool $4 billion together, buy 90% of the fund, save the system. They agree. The banks inject $3.65 billion. Long-term capital survives. Markets calm down. And over the next year, the banks actually make a 10% return on their money. The partners lost everything. John Meriwether's personal fortune? Gone. The Nobel winners? Humiliated. But here's what no one talks about. 6 months before the collapse, Meriwether walked into the Federal Reserve and admitted they were in trouble. He asked for help. The Fed said no. Then the fund blew up, and the Fed had to organize a bailout anyway. So here's the question they never answered. What if Meriwether had waited one more week to ask? Hi,